Well, hello, everybody. Good morning, good afternoon, good evening, depending on where you are. So great to be with you all today to talk to you about this concept of financial forecasting. And going to make it extremely hands-on. I think that's the only way to really learn this well and to understand it. And I'm going to drop in the chat function here in just a couple of minutes, a couple of spreadsheet models for you to use, one which is a template and one which is a sample. And I'm going to go through both of those as we go through the session here. I'm going to give everybody here another minute just because I know some folks are drifting in and I want to make sure they get access to the two spreadsheets. So while we're got another minute here, I want two quick questions or one quick question from all of you in the chat room. So a ranking of 1 to 5. 1 is I have no idea about forecasting at all. And a 5, I've got this. I think I'm going to leave now and go to another event. All right. So 1 to 5, just really quickly, anything in between there would be helpful for me to see. All right, I'm seeing a bunch of 1s and 2s, couple 3s and 4s in here. All right, 1s, 2s, 4s, 1.25, 2s, 3s, 2s. Okay. All right, generally pretty good there. I like that. Good. All right, good stuff here. So no one's admitting to a 5, at least anyway. And in terms of maybe you're a little bit too overqualified for this one. So what I'm going to do to a couple things. The first thing is that these models I'm showing you are very simple. They're very straightforward. I tried to make them as easy as I possibly could to enter in numbers, just so it could really work for anybody. And I'll show this to you all in just a few minutes as we go through that. The second thing is, I left out a lot of places I would normally put in shortcuts and do things like that. And, and again, I'm just keeping it simple. So folks who may not have a lot of experience at financial forecasting or with Excel would be able to, access into these models. So what I hope is for the beginners, they can use this model right out of the way, right out of the gate and put numbers in and start to work it. For those of you who may be a little bit more advanced, you look at this and you go, oh, hey, I kind of get it now. I see where you're going with this, and either rip the model apart or go build your own. Your own one from that. So that's kind of what I hope from both of these, from the session here today. The other issue is we have to fully understand that you cannot outsource knowing numbers about your business. Okay, this isn't something where you can hire somebody to do this for you. You need to understand all aspects of numbers for your business. It's just a must. Everything you do ultimately ends up in numbers. Every marketing campaign, every revenue model, every cost, everything that you do, people that you hire, ultimately everything gets chiseled down into numbers. And so that's where we're going to end up today as part of our framework and discussion here. So what I want to do is I'm going to drop in the chat room two models, one which is a template and one is a sample with numbers. So these are coming out of Dropbox, so hopefully you guys can get them. And I'm going to drop the template in first, and I'll just ask for a couple of thumbs ups to make sure you guys can open this and just download it off into Excel or whatever program you've got. And so I'll put the first one in here. So if folks can open that up and just give me a quick little thumbs up, that would be great. And then I will drop in the sample also. All right, got a couple thumbs up showing here. So it seems like folks can get into it, which is the most important thing. And so then here's the sample model to go with some numbers here. All right, you don't have to have this open right now. These are just for you. I'm going to go through both of these on a shared screen here so that you've got them. But now you have them and you can feel free to do whatever you like with them in terms of using those. All right, so let me pop in. I will, Roxy, maybe if you remind me at the end, I can do it. I can drop these in again for anybody who's arriving right now, so that I'll put them back in the chat room again at the end for late arrivals. All right. Okay. So let's look at the template. All right. And let me quickly orient you to the model itself. And the key thing here is there's a bunch of little worksheets going across the bottom that you can use. There's instructions here. Probably the most important piece of the instructions is that anything in green are numbers that you can change. Anything in green are numbers that you can change, and anything in purple are words that you can change. Okay, you can obviously change other words, some of them, not all of them, because some of them are actually formulas being pulled from a different page. But absolutely anything in green and purple you can change. Any number that is not in green is a formula. None of the formulas are protected. So if you make any changes, you're going to make changes to your structure. So if you know what you're doing, fantastic. If you don't, I would recommend you stay with the green areas as much as possible to make it easier for yourself. Okay. So then I've got these different worksheets going across the bottom. I have what's called the startup tab here. And this is where you can list out various startup costs before you get into your model. So these might be sunk costs already. These might be costs that you want to try to recapture with any fundraising you might do. But these are things really before you start into your monthly and yearly forecasting that you're coming up with. So you can write them down here, whatever they are. You can put the dollar amounts here, and it's very important to write assumptions for everything that you have, not only for yourself, but if you're ever going to share this model with other colleagues or investors, you want to be able to have detailed assumptions to go with this. These numbers do not tie into the actual 3-year forecast model, but they do go into your financial asks later on when we talk about the capitalization table and the ownership table here in a little bit later on for the discussions here. So this is sort of a standalone, give you a place just to park some of these startup costs that you might have already. In the second tab, this is our revenue and cost of goods sold tab. Okay, so again, everything in green, you put in numbers, and everything in purple, you can put in names. I've given you 3 revenue stream options as a starting point. Obviously, you can add more. You can maybe only have one, whatever it is, it's fine for you in terms of what you have here. I have given each revenue stream a price per unit, and I've used 1 cent just as a placeholder. If I have 0 there, a couple of the spreadsheets later on goes a little bit whizzy, and you get that divide by 0 thing that can kind of freak people out sometimes. So just to make those all disappear, I just put in 1 cent just as a placeholder for everything that we do. So these are price per unit, very important, price per unit that we have here. Then I have 3 years going out, year 1, by month, year 2 by month, and year 3 by month. These are units sold. This is not revenue. These are their units sold. So I've got a price per unit and units sold in each of these particular months that we have here. These will roll up into our third sheet here under the income statement here. And when we put those numbers in, but remember, these are units for each of these. So I've got 2 revenue streams. They could be anything sort of a straightforward price per unit, and then the number of units sold going out for 3 years, 36 months. In the third revenue stream, I've set it up as a subscription model. I got a lot of questions on this over the years about setting this up. And so I set this up as a subscription model, if that is your revenue stream, so that you could add new subscriptions, and eventually you're going to have people that are going to be deleting or canceling their subscriptions, where you can actually take those away. So, you know, if you put in 10 here and 10 here, those all total up. But then if I take away 5 here, they begin to drop off. So this gives you a chance to, you know, to really build out a subscription model if that is one of your revenue streams that you have here. So again, kept it pretty simple here. And this goes all the way out for 3 years from our revenue model. All right, from our revenue models here. Then, oops, sorry about that. Everything out here. Oops, and then 1 more 0. Good. Then I have reflective cost of goods sold. And for those who don't know, cost of goods sold are on a per unit basis also. And they reflect the amount of cost it goes into making that 1 unit that you're having here, revenue. So price per unit revenue now corresponds on a cost basis. So this works pretty well for products, because you can understand pretty well that, you know, here's my iPhone right here, and I can sell this for $1,000, my price per unit, but it has costs that go into making this, from the shell and the screen and the computer chips and the camera that actually go into making this 1 unit. That's what these costs are. These are per unit cost that go into making our product or service, right? Service is a little bit more challenging. Not completely, but if you're building a software as a service or an app, many of those costs actually aren't considered cost of goods sold. They're considered fixed costs, because we can't really amortize out a coder who's building an app that could work for 1 unit of an app to 50,000 units of the app. So we generally put those in another cost category, which I'll talk about in a minute. But again, I've set up for each one of these your potential cost of goods sold, how much it would be for each of these, and of course your assumptions. And this is for all three of your revenue streams. So you see revenue stream 1, revenue stream 2, and then revenue stream number 3. And again, these go all the way out for your 3 years, okay, in terms of the numbers going out. So you would have a reflective of your price and cost of goods sold for each of your different 3 revenue streams that you might have. All of these, the revenue and cost of goods sold, roll up into your worksheet number 3, which is your income statement at the top. And each of these revenues will pull over revenue stream 1, revenue stream 2, revenue stream 3, cost of goods sold 1, 2, and 3 will also pull over. And then these numbers will automatically calculate from your previous thing. So you can tell these are all formulas because they're not in green, right? These are all formulas going across the board here and going out for 36 months for your 3 years. All right, what we're able to calculate, what's calculated for you then is this gross margin number and this gross margin percentage, which represents the difference between revenues and cost of goods sold. And what that number is, whatever number is left remaining is how much you have left to pay for everything else to run your business for that particular time period, in this case, for this particular month. So I've created for you a whole bunch of potential fixed costs. These are sometimes called direct costs or sometimes called S&G. They're just different names. Unfortunately, we haven't decided on one of them. I call them fixed costs, but you might see this as selling and general administration. You might see them as indirect costs. You might see them as fixed costs, I said before on that. So I've given you some placeholder here: employees, contractors, office rent, marketing campaigns, legal, travel, fringe benefits, which I'll talk about a little bit later on. Just giving you some starting points for names. You can change every one of these, obviously, because they're in purple. So you would want this to reflect your business model. CEO, CTO, director of marketing, coder, administrative support, whatever it is. And then however much you are planning to pay them over a monthly period of time. So you can just put in numbers straight in here. So you could say 2,000, you could say 5,000, whatever those numbers might be. And again, I kept this simple. Data entry going in, you could have set this up with a couple of formulas to make it easy. But this goes out for all 3 years, okay, in terms of your number inputs for all of these different categories. That's it, folks. There's your model right there. That's your inputs, your startup costs, your green boxes, those revenue streams, the cost of goods sold streams, and your fixed cost streams, okay? What else we have is a couple things where the numbers then consolidate for us, and we can use these numbers to help us, start to interpret some of the data here. So I'm going to go to the 5-year forecast summary. So this is a summary of the 3 years financials that we just did, those 36 months here. All the revenue streams by year will be captured. All of the cost of goods sold will be captured, and all of our fixed costs will be captured in these 3-year forecasts going all the way down the line. So everything we just entered in will show up in a yearly basis, so we can get a much clearer and cleaner snapshot. What I've done for year 4 and 5 is I've created this growth escalator. So instead of having to run these same numbers again for year 4 and 5, I decided to keep it a little bit simpler. You can easily take and copy what you did in, for year 3 and make it out to year 4 and year 5. But again, I just want to keep it a little bit easier for us. And these growth escalators would be, how much we think will grow from year 3 into year 4. So this number right now, I have it at 1.0. If we think we're going to grow at roughly 20%, give or take a little bit, we could say 1.2. If we think, 1.2. If we think our growth escalator is going to be, roughly 50%, it's not quite right, but close enough. 50%, you could do 1.5, or so on and so on. And that's going to impact your what it's going to show from going from year 3 to year 4. And then this number here would show from year 4 to year 5. So it's just a shortcut way just to get out to year 4 and 5 from that. And so these 2 green boxes represent the growth escalator for the revenue and the cost of goods sold. And then I have 2 more down here that represent your fixed cost. Okay, so your fixed costs will also grow, but they probably won't grow as quickly as your revenues. So if your revenues are going at 1.5 from year 4 to 5, or from 3 to 4, maybe this is 1.21 or something like 1.3, something like that. It's close. It's not fully accurate. I mean, one question I get a lot is, well, as you grow, your cost of goods sold are likely going to go down a little bit because you're getting economies of scale, and that's true. I don't have that reflected in this model, but certainly we do here, obviously, if you put in the right numbers. So there's a few things that might be off a little bit here and there, but at that point, forecasting is definitely an art, not a science. And as we get out to year 4 and 5, it's probably a good thing that we estimate our costs a little bit higher than what we think it might be, just from that standpoint of being a little bit more accurate with it. So this is a summary of all 5 years at the yearly basis. There's also a cash flow statement, which is pulled from the previous statement. I'm going to show that to you when we get to the sample numbers. And then finally, a summary of just the top level. Here's revenues, years 1, 2, and 3, 4, 5. Here's the total cost of goods sold. Here's fixed costs, operating profits, operating profit numbers, operating profit percentages here. So these are numbers that show at just a very high level, snapshot level. And this is often what you would show potential investors first, as something you might show them instead of your detailed financial model, but something to give them a snapshot of what you have. A couple other things real quickly. It's all graph for you also. So it's graphed out, so you can use that if you want to. And then there's a couple of other worksheets in here. There's a cap table that is generated from this, and I'll show that to you with numbers to show you how that actually unfolds. I have a break-even tab here too, which is, it's okay. It's okay if you have one product, because then you could really figure that out pretty quickly. If you have multiple products, it doesn't work as well, but it's in here if you want to use that. And then here are some calculator tools that you might be interested in using at some point to help you figure out some of your costs. There's a couple of small business calculator tools, pay-per-click, email marketing cost, Google AdWords rates, displays, influencer rates, more marketing stuff that you might be doing. There's some things here that you could click on to get you to some information on that. So that's a summary of what the model looks like and all the different pieces to it. What I'd like to do is show you with numbers, because I think that's the best way to really illustrate something like this, is to show you with actual numbers, and then you can see what it looks like, from that perspective. And then I'll go into some other details with the model too, to help you like understanding cash flow, understanding how it ties in with the cap table also. So let me go in and I will look at the sample now with numbers. And it's set up exactly the same. No differences. The models are the same in terms of the setup. I've got the instruction sheet here, just as with the other one. And now I've got startup costs. All right. So my company is selling lacrosse sticks. All right. That's what we sell. We sell lacrosse sticks and some other things too. But our main business line is selling lacrosse sticks. So I've got, some startup costs, maybe my initial sticks and costs for making the sticks and things like that. So I just put some numbers in for these, for some initial startup costs and some assumptions. And again, these assumptions are kind of weak. You'd want to have something a lot more specific in terms of that. But again, just to give you a little bit of a flavor for that. So I'm saying to launch my Lacrosse Sticks Forever LLC, I'm going to need $70,000 in startup costs to launch my company. Now let's go into the model here a little bit. And let's look at our revenue and our revenue streams. So my first revenue stream is going to be lacrosse sticks, and that's what I'm going to be selling. All right. And I'm going to be selling these online. I do not have a physical store, so I'm going to be selling these online. My price per lacrosse stick is $100. That's what I'm selling lacrosse sticks for, $100 in year one. And these are the number of lacrosse sticks I think I'm going to sell in each of the months. So my first month, 50, month 1 and 2 and 3, 200, and months 4, 5, and 6, and so on and so on. And I built this out going forward. So I'm still keeping my price at $100, but you can see my units are going up, each month from this, all right, as they go forward. And I'm growing by selling more and more lacrosse sticks. All right. My second revenue stream, I don't have one. I just left that blank. I have a second, well, it's in the third slot, but it's really my second revenue stream. I have a practice facility outside of Philadelphia, Pennsylvania, which is a lacrosse practice facility. And what I'm going to charge is a subscription for people to use it. So it's a playing field. They can use it to have scrimmage games on. They can use it. There's nets on there. There's boards to hit and throw against. It's a facility that people can use. And I'm going to charge a subscription fee of $10 a month to use this facility. And so I'm charging $10 a month to use it. And here's my new subscribers each month: 50, 50, 50, 75, 75, 75, 100, 100, and 100. And what I'm saying here is after 3 months, the people are going to start to drop off. So in month 4, 10 people drop off. In month 5, 10 drop off. In month 6, 10. And then a few more, 15, 20, 20, and so on. So each month I'm gaining subscribers and I'm losing people for whatever reason. They don't want to do it. They're tired. They're moving, whatever it is. But this helps me reflect a little bit more accurate what a subscription model looks like. New people coming in and others leaving from that. Okay. And that goes all the way out through year 3. So those are my 2 revenue streams: selling lacrosse sticks and selling a subscription model for a practice facility that I have right now in Philadelphia. So now let me look at my cost of goods sold for this. So I'm selling my lacrosse sticks for $100, okay, per unit. So my cost of goods sold then are things that's going to cost me to make each unit of that lacrosse stick. So I'm saying my supplies, my wood, my netting, my plastic parts are going to cost me $10 per lacrosse stick. To assemble them and put them together, I'm saying it's going to cost me $40 per lacrosse stick. Shipping to a distribution center from where it's being made to a distribution center, $3. And then actually to ship it from the distribution center to my end users, it's going to cost me $2. So my total cost of goods sold is $55. I sell it for $100. It costs me $55 to make and ship for each individual lacrosse stick that I have. So my gross margin then is $45 per lacrosse stick. I have $45 per lacrosse stick that I can use to pay for everything else in my business model, all of those other fixed costs that are on my next sheet coming up here. Let's look at my cost of goods sold for my practice facility. Okay, it's kind of hard to have cost of goods sold for a practice facility, right? Because it's one big, grass or astroturf that's out there. And it doesn't matter if one player is using it or 25, it's still going to cost me the same every month. So that cost of the practice facility is actually going to show up in my fixed cost. Because again, I can't get it down to a per unit user base of using, because it's there. It's going to be used it can be used by 10 people, it can be used by 100 people or 200 people at the same time. So that has to go on my fixed cost. But anyway, I've kind of came up with something. I figured out that maybe $2 of expenditures is something I could do as a cost of goods sold for each person. So clearly my margins are much higher here, running at 80%, but it's a little bit off because, again, I had to put some of these costs into fixed costs. So this is something, you always have to look at, particularly when it's a service, and this is a service, of what actually can you get down to a per unit cost, or if that cost should show up under your fixed cost. Now I have this going out for 3 years. All right. My cost of goods sold. One thing that's really important to look at, though, is if you see this right now in year 1, my cost of goods sold is $55. As I go out into year 2, even though my revenue is the same per unit as 100, my cost of goods sold start to go down a little bit. And that should happen because my units are going up. I should be getting better prices. If I'm ordering 700 or 2100, lacrosse sticks for 3 months from my suppliers, I should be getting better pricing than if I was only ordering 50 or 200. So my economies of scale start to improve. So that means my cost of goods sold should start to drift downwards a little bit as my sales go up. I should get better pricing. And same thing for year 3. All right. So these things should start to go down a little bit as you start to sell more because you're starting to get better pricing. All right. So all these revenue streams and these cost of goods sold will show up now on our income statement. Okay. And so with our income statement, they're automatically calculated for us. These things are brought over each of the months. So I've got my lacrosse sticks, and see, I put that name in there for my revenue stream. And by changing that name, it's now showing up over here as my revenue stream. And then I've got my practice facility. So these are my total revenues. When I add these 3 together, my total revenues for each month are these. And you can see they're increasing as my sales obviously start to increase. They're going up each of the months. I have my cost of goods sold here. You know, same thing. My cost for making it has now been aggregated based on the number of lacrosse sticks and the subscription models that I'm selling here. So my total cost of goods sold for each of the months is here. And then my gross margin, which is revenues minus cost of goods sold, get us this gross margin. That's how much money I have left each month to pay for everything else in my business model. So you can see over time, my gross margins kind of fluctuate a little bit, getting a little bit better, you know, going up just a little bit here. And as we said, they probably should, because I'm getting better pricing on my costs. So my margins are getting a little bit better. I'm getting more efficient, which is good, right? I'm getting more money that I can use to pay for my other costs. So now I've filled in other costs here. I put in names here for a chief executive officer, chief marketing officer, director of product development, marketing managers, website people, contractors, you know, and I put in some numbers here, right? You know, to pay these folks here. I've put in some office rent. I put in, oh, here's the big one. Here's my practice facility, right? It's going to cost me $3,000 a month to rent and maintain this piece of land that I've created here. So again, I couldn't put that in cost of goods sold, because I can't amortize that out over each unit of a subscriber. So I put it here as a fixed cost. And then I have others, communications, advertising, you know, legal, regulatory. I have this fringe benefit number here of 12%. If you look at the formula, you can see I'm taking this on D24, D25, D26, D27. These are my considered employees in the company right now. And this fringe benefit, as a startup, you're probably not going to have things like health insurance and, you know, 401k plans yet. That may come a little bit later, but you do have some obligations to pay for certain things if they're employees. You have to pay half of Social Security. You have to pay Medicare. You might have to pay some other taxes that are state or city or local that add up to a number. And I've just used 12%. That's kind of the bare minimum that you would need. For a full employee in a full business, you know, company that has all kinds of benefits and stuff, that number is closer to 30 to 35% of their salary, of the amount that they get paid. Okay, so as you grow, this percentage could increase each month that goes up. So what I've done is I've done this out for 3 years, right? And you'll notice that as we grow, you know, maybe I increase some salaries for us. Here it's $3,000 a month, and now I've increased it to $5,000. I've also started to add some people, right? Some more folks in here as we grow. In year 3, look, I've added more people, more contractors, more folks. Of course, as we're growing our revenue stream, we're going to have more costs to go with it. So that's a natural flow to have those things take place. As you grow, you're going to be adding more expenditures to go along with us. Okay. So once we do all of that, we get to see what our operating profit or operating loss is every month. Here's our revenue coming in. Here's our cost of goods sold. We subtract that from revenue. Here's all of our fixed cost. Subtract that from revenue. When we add up all of our costs minus our revenue, we have what, 5,000 roughly in revenue minus 29,000. We're showing an operating profit loss at this point. We lost $23,000 in month 1. Right? We lost the same in month 2 and 3. Then we lose money still in 4, 5, and 6, 7, 8, 9, but we're losing less. Okay, so we're getting better, right? We're still losing money, but we're getting better at that number. Operating profit is also called operating income sometimes. It's also called EBITDA, earnings before interest, taxes, depreciation, amortization. It's everything. From a startup, this is the most important. So this number is important to you. Understanding net income really isn't that super important for you right now. We want to understand the money coming in and the money going out in terms of the operations of your business. So this number is more important to us generally than a net income number is right now at this point. So we call this operating profit, operating income. It's also called EBITDA, you know, too, in the accounting world. So we have these numbers that go out for the 3 years. All right. And I'm going to come back to cash flow here in just a minute and what this actually means, but let's look at it from a 5-year basis. So all these numbers roll up into a yearly basis. So now you can get a kind of a nice snapshot, and I can see my revenues have gone from 316 to 213 by year 3. I've given it a growth growth escalator 1.3 and 1.5 from year 3 to year 4, year 4 to year 5. And so I go from 2.3 million to 3.1, 3.1 to 4.6. And that shows my 5-year high level annual revenue forecast. Same thing with cost of goods sold. They're down here in terms of the cost. The gross margin percentages are all tallied up. All of my expenditures for each of the 3 years show up, so I can take a quick glance at them and see what they have here. The escalators are put in at 1.15, 1.2, so I can see the changes here. It's really good to look at this closely because it's real easy to make an error. You know, instead of 60,000, this could show up at 600,000. It's a great way to kind of step back and look and say, oh, man, I must have put something in wrong here. That really, it shouldn't be 600,000. It should be much lower. It's a great way to sort of see that number at a high level. The numbers then tally down here, and they tally up to what you saw on the 3-year, 36-month forecast. And we can see the cash flow, cash in, which I'll talk about here in just a second. And then finally, your real high level summary numbers of just revenues, just cost of goods sold, just gross margin, just your fixed costs, just your operating profits, so you can really see a high level number. And like I said, these are numbers that you might share with investors, as your first round. So real high level numbers, which you have here. It's also all graphed for you, so you can see it from a graphic standpoint. So all the things key into it. Again, something you might share with somebody outside of the group here. Okay, so that's a 3-year, 5-year forecast of revenues coming in, money coming in, and your money going out. Well, there's a couple more things that this model helps us analyze. One is, and I'm back on the income statement fixed cost worksheet here. One of them is to understand our cash coming in and out of the business. This model is set up so that everything lines up in the same month. And so the assumption here is that all your revenue is coming in 1 month and you're expending all your expenditures in that same month. In reality, your business model could be very, very different. If you are, well, let's make an example. In the airlines industry, for example, they collect our money when we order a plane ticket. It could be anywhere the day before we fly. It could be anywhere 6 months earlier. They charge our credit card and they have that money. They're using that money right now for stuff. They're using that cash flow for helping them. Then when they get, when we actually fly, then they move that money on the accounting tables into income. I'll keep that a little bit separate, not a big deal. But anyway, from that perspective, not including buying the airplanes, it's a pretty good cash flow positive business. In my previous life, before I joined American University in our Center for Innovation, my company did a lot of government contracting. It's a very poor cash flow business. I have to pay for all of my stuff up front, pay my people, invoice the government for it, and get paid anywhere from 30 to 60, sometimes 90 days, unfortunately, after the fact. So my cash flow is really tough. So I kept this pretty simple, lined it up, right up and down. But your real business model could be very different on how the cash in and out works. But I want to do this so you could see what it means from a cash flow standpoint, but also from how much money might I need to raise to start and run my business for a particular period of time. Okay. And so by taking this in and out, the revenues coming in, the cash going out, we get this monthly ending cash, which ties in right now with our operating profit and loss. This monthly cash ties in exactly with that because I lined them up month by month. But what happens though is we need to understand the cumulative effect of this, okay? So if we lose $23,000, $23,900 in month 1, and we lose $23,507 in month 2, these numbers become cumulative. That becomes a cumulative negative amount of money that we're losing every month, which means we have to fund that in some way. We've got to cover that loss. A business can't lose money for any long period of time without ways to finance that particular loss. And in a startup, that means taking investment in. We're not going to get bank loans. We're not going to get loans from other folks, maybe family and friends, but again, set that aside. We're going to have to take investment in to fund this cumulative cash flow loss that we have, because we can't run a business on negative numbers in the long run. So what we do is we look at this and we sort of scroll out and we say, wow, okay, we're losing money and it keeps getting bigger and bigger, right? This negative cash balance cumulative number gets bigger and bigger and bigger until a certain point in time. And this is the point in time, if we go up and we look at our operating profits and losses, all the way up to month 15, we've been losing money every month, month 16. In month 17, something happens. Our revenues exceed our costs. So this is the first month where we actually make a profit. So somewhere between month 16 and 17, we break even, right? Somewhere in there, the revenues are now exceeding our costs. So somewhere in there, we've broken even, and now we're starting to be profitable in the ensuing months, going out further and further and further. So this has a really important piece for us to look at our cash flow. And so these two numbers down here is when something happens also. We have been losing money every month. Our negative cash flow has been getting bigger and bigger and bigger, up until a point here where it starts to go down now. We go from 179 to 183 to negative 176, negative 169, negative 160, so on and so on, because now we're bringing in profits to help us pay for this, to use that money that brings our negative number down. So what's important for us then as startups is we've got to fund this number. This is our worst cash position on a cumulative basis, this negative $183,400. So if I put that in this green box here, 183,430, okay? Now what you see is this is like our starting point of money in the bank for us. We have $183,430 in the bank, which now allows us to finance these monthly losses, okay? As we're growing the business, as our revenues are growing, we use that money to finance those losses as we go through it. So that's great. So now we stay cash positive, even though our bank account's getting drained every month, right? It's getting drained every month that we go through this until we get to zero, right? And then the next month, we turn cash flow positive, profits, and now we're starting to go in the other direction here. So this helps us understand how much money do we need to run the business for, in this case, 16 months. So the lingo here is we need $183,000 for a 16-month cash runway to fund the business. After that point, we turn cash flow positive. We turn profitable. Well, from a standpoint, this is the way we would structure, but to be a little bit more unconscious, we want to make, or a little bit more concerning that we know cash flow projections can be wrong. We want to have a little cushion here. So maybe I multiply this by 1.2 just to give us a little bit more. So instead of 183,000, I think we need 220,000. So now I would say we need $220,000 for a 16-month cash runway of the business before we turn financially profitable. So now you can start to see how our financial forecast can turn into an analysis of how much money we may need for our company. So now let's look at the cap table, our capitalization table. So in this case, I've put in some owners here. I've got Michael Jordan and LeBron James, who own, Michael Jordan owns 60% and LeBron James owns 25%, our initial owners of the company. And we set up a 15% stock option pool. The reason why Michael Jordan owns 60% of the company is because I did my undergraduate at UNC Chapel Hill, and I went to school when Michael Jordan was there, so he deserves to own 60% of the company. So that's what it looks like before we take investment in, okay? So that's our initial ownership structure. Here, in this red box here, this number represents three numbers. It represents our startup cost of $70,000. It represents our cash that we need, $183,000, plus the 20% roughly contingency that we have here. So this number automatically pulls from those two places. If you look up in the formula here, you can see where those numbers pull from that particular number here. And so by doing this, this gives us a little bit of an idea of how much money we need to raise to run our business till we're cash flow positive. We need, in this case, $290,000 for our startup costs plus the 16-month cash runway. Then you can use this to sort of figure out how much equity you want to exchange for that cash to then have that money come in. And I just put in 20% as a starting figure here. And if I do that, then Michael Jordan gets diluted from 60% down to 48. LeBron James gets diluted from 25 down to 20. Our option pool gets diluted from 15 down to 12. And we have a new owner, Kevin Durant, who now owns 20% of the company. That's what that 20% represents here. This could be 15%, and those numbers will change. It could be 10%. Those numbers will change. But what also is calculated for us through this is a pre-money valuation and a post-money valuation. Pre-money is the money before the investment comes in. Post-money is simply adding pre-money plus the amount invested to get us to a post-money valuation. So this gives us a real simple first calculation of our money that we need to consider raising and how much equity we would exchange for that. So the way we would state this, we'd say is, we need to raise $290,000 to pay for our startup costs, give us a 16-month runway, and we're willing to exchange that investment for 20% ownership of our company, which means our pre-money valuation is $1.1 million and our post-money valuation is $1.4,500,000. And that's how you would articulate it. That's how you would state that from that particular perspective here. So that's kind of a rundown of the models, the template, as well as the sample here. And did that in 42 minutes, which is a world record for me. So questions, comments, thoughts, anything I can help you with on this, that you might have anything on this. Okay, so Jessica, how do you showcase financials for tech that's built on virality first and then revenue once traction escalates? You would just have zeros in revenues, right? You could have zeros for 6 months, 12 months, whatever, and then you calculate your cost, that you would have while you have zero revenues across the board here. I started it in month one, lining it up, but you could have zero revenues for a long period of time. You'd have to really describe that well to your investors, and how that works, but you just put zeros in revenues. For service-based projections, how can we best, sorry, that's from a Reiner. For service-based projections, you may not have any cost of goods sold, all right? None, okay? Because everything goes to fixed costs, because it's real difficult, particularly if you're a software, to amortize that out over users, because a coder is building this for one user to use, 10,000 users, 500,000 users. So you can't really do it from that perspective. So all those costs, you would have 5 coders that are listed in fixed costs, and not in that area. Now, if you have something, let's keep it in apps. If you have something in the App Store, for example, well, Microsoft wants, 20 or 25% of every download. That would be, if you're selling downloads, say at $2 a download, you're going to have a cost of goods sold of just, of those costs from, Android or Apple, that you'd have to pay, and you'd put that in there, 20 cents per download or 50 cents, whatever those numbers are. Yeah, basically, VJ, yeah, no cost for services. And I shouldn't say that's not entirely true. I mean, if you're running let's say you're running a training company, okay, and you collect, $2,000 in every person in revenues. Well, for that training event, you're going to have faculty costs. You're going to have coffee and tea costs. You're going to have, maybe administrative costs. So you could put that in there. Those would be cost of goods sold, because that would be tied to that one training event. All right. What about writers, consultants? Would time estimates, subscriptions be included? Yeah. If you have let's say somebody asks for a fixed price on your time, and or you have certain services you charge $25,000 for, you could have a cost of goods sold that says, I have to pay 2 consultants, $5,000 each, so it's $10,000, but I get to collect $25,000 in revenue. So you could do that. Where would you document monthly or annual expenditures? I'm not quite sure what you mean by that. This is for forecasting. You definitely, if you're accounting for stuff, you should use an accounting software that would do all of this stuff for you. And they have forecast tools that work too. I think they're a little bit overly complicated for startups early on with things. So it sounds like what you're asking there is something that your accounting software might be able to handle a little bit more. Barry, dilution. Yes. So remember, anytime dilution takes place. There's a value exchange here, right? If you're taking investment money in, you've got to give up something in exchange for that, which is equity in your company. So how you decide pre-money and post-money valuation for the amount that you invest in the company will impact your dilution. This is a very simple dilution. I mean, this is a one set of where we start and where we end up. Cap tables and dilution tables can be far, 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 far more complicated with it. So just remember, the simple thing is you need to understand, you need to discuss or negotiate, finalize what the pre-money valuation is for the amount of money you are going to get invested in that company, which will then calculate how much share ownership somebody gets from that. For social media app, would you focus more on users more than revenue? It depends. I mean, if you are a consumer-based social media app where your goal is to get 100,000, 500,000, 2 million people signed up, you're about getting users, okay? If you're a business app where you're more about getting users, but also getting, you know, you're going to charge for that, then you might be a little bit different here. You know, a good model is, you know, you offer that freemium for 30 days or 60 days, you get them hooked on it, and then you start charging them for it, right? You know, once they're in, you know, this is where CRM packages were really, really good at getting people in. They got you hooked, they got you using it, and then to get yourself out of it was too challenging. You'd be fine paying the cost to go into it. So again, it just depends on what your goal is. If you're trying to go after millions of users, you got to have a user principle first, because that you get the users, the revenue will follow later. But if you're more of a business to business model, you could probably get to revenues sooner from that in some way. All right. Other questions? I'm going to put it back into the, I'm going to copy and paste these back into the template and the sample for those who came in later after the chat room started, because you don't see the earlier chats, so that those who came later can have the model. Okay, oops. While I'm doing that, if anybody else has other questions.
I have a question, Professor White.
Yes, DJ.
So if we have a service-based business and there's no cost of goods sold, then how do we determine what would our gross margin look like?
Yeah, your gross margin would be 100%, right? Because because it just would. If you don't have any, it's just going to be that number. If you don't have any cost of goods sold to go with it, and that's okay, because I would look down at your fixed costs, and if I see you've got 4 engineers and 4 coders that you're paying, whatever, $100,000 to $200,000 a year, then I know you've captured that cost already. You've captured that expenditure in a different way. How do you calculate advertising? Again, everything is going to be different on that. There's really good, there's good industry standards out there. Like if you were going to do paid advertising in social media with a Facebook or with Google Ads or influencers, there are numbers out there that you can use to benchmark how well you do with it. There's also great, they all have great dashboards and calculation tools. And I use social media in my classes as an example, because the dashboards are really good and you can change ads up and you can really work with them. I wouldn't necessarily say they're the best thing, for actual advertising all the time, but they're a good tool to understand how you figure out what ultimately becomes your customer acquisition cost, lifetime value of customers, which are very important to investors. So I would look at a tool, pick Google AdWords or one of the Instagram influencers, research on them, open up their programs, put $50 into it and start practicing and using that. And that'll give you some ways to understand how those tools work. And then you can extrapolate that to other mediums. Email marketing is still one of the best, methods out there in terms of return on investment, for example, but you got to build up an email list, to get there, to be successful with it. All right, anything else? I'm putting in my email if anybody has any questions on the model, or if you work through it and you want to review it. I'm more than happy to do that with you. Yeah, so I'm happy to help anybody as they go through it. And as I said, this is just a starting point. And for new people, this can be a great way to start to understand how money flows in and out of your business and how much money you might need. For more advanced people, hopefully you sort of took this and said, okay, now I get it. And I see what I need to do. I can make this model, fit my business much better and much easier, from it. So I hope for both parties that was useful to everybody. All right. If that's it, everybody, thank you all. Have a great rest of your day and have a great DC Startup Week. I encourage you to go to as many things as you can. It's a wonderful program that's out there for us all. And I just applaud the folks at DC Startup Week for doing a great job for all of us here.